Hi, and welcome to On Point, a podcast by Oak Street Funding, where we bring research and data-backed insights to dig into the minds of industry leaders to learn how to stand out and navigate and break through this ever-changing industry. I'm your host, Bridget Height, and you can support this podcast by following us on Spotify, Apple Podcasts, on our website, or wherever you get your podcasts. We'll be there hanging out and talking to industry leaders and ready to empower you to grow your business. So let's get on point. Today, I am delighted to bring Steve Blake to the show. Steve is Managing Director at CBIZ Somerset's dealership team, where he focuses his time on mergers and acquisitions, tax strategic planning, and tax compliance. So today, we'll continue the discussion from our January tax implications webinar about 2024 tax changes and implications and the potential impacts it could have on the market, our borrowers and business owners as well. So Steve, thank you so much for being here.
Of course, my pleasure. Thank you for having me.
So we'll just get right into it.
Sure.
To start, can you talk about the potential tax changes that we might see in 2024?
Yeah, sure. So as we move into 2024, we've got a lot of changes that are coming into play. You know, the Tax Cuts and Jobs Act that came out in 2017, right. A lot of that is starting to expire. We talked about that some on the webinar, but to get a little more specific on that, for example, bonus depreciation, where we can take 100%, at least for the last several years, we've been able to take 100% depreciation on our fixed asset purchases and deduct that full cost in the year we buy them. Part of the Tax Cuts and Jobs Act phase out is we're slowly phasing out bonus depreciation. So 2023, we're only going to be able to take 80%, not 100%. And then it goes down 20% every year until bonus depreciation is gone. So I think in 2027, bonus depreciation is gone.
Oh, wow. Okay. So that's one thing. So something we discussed in the webinar was the ending of the Tax Cuts and Jobs Act. Mm-hmm. What are the potential implications of it ending in 2025?
Yeah, so there are a number of things that end in 2025. It'll be the last year for them. So 2026 is where we'll really start to see some of these impacts. Okay. But, you know, some of those provisions that are going to go away, for example, the capital gains tax rates. Mm-hmm. With the Tax Cuts and Jobs Act, the rates stayed the same, but the level of income they were applied to changed. Oh, okay. So we've been able to get a benefit ever since 2018 by paying less on those long-term capital gains. And then those go back to the way they were after 2025. So okay. Once we get into 2026, you could have the same capital gains issue, but your tax could be significantly higher because of the brackets that are being applied.
Okay. So how might small businesses be impacted by Section 179 deductions?
Yeah, so that's a great question. So kind of related to the whole bonus situation. Bonus, if you can take it, is better. There are a lot of situations where you can't take bonus depreciation. 179 is almost a similar concept. It's an election that you can make to expense the cost of those assets. So it's not really depreciation, but it kind of gets you to the same point. Okay. But there are more limitations on 179. So 179 has a limit. First of all, it can't create a loss. Bonus depreciation can create a tax loss. Okay. 179 can just take you down to zero. Oh. And then there are limits in place on how much 179 you can take. So for 2024, I think it's roughly about 1.2 million is your limit on what you can elect for 179 to expense in the first year of fixed assets. The problem runs into, though, when you purchase a lot of fixed assets. So when you're acquiring a business and you're acquiring their fixed assets, mm-hmm. you need to be careful how much you're allocating to those fixed assets, because once you get above a certain dollar amount, you start to lose that election. So for 2024, it's roughly $3 million. So once you've put into service $3 million worth of new assets, every dollar above that, you lose $1 of 179. Oh, okay. So at roughly 4.2 million of new assets, you have no 179.
Steve, can you tell us about the net investment income tax and how it might impact business owners in 2024 and beyond?
Sure, yeah. So the net investment income tax actually came into play back around 2013. Okay. So it wasn't part of any of these more recent tax acts. It's essentially just an additional tax on net investment income. So we're talking interest income, capital gains, dividends, those types of income. It's an additional 3.8%. Oh. But it's only for people that hit a certain level of income. Okay. So for married filing joint, I think this year it's $250,000. Okay. So if you have taxable income above $250,000, Anything above that related to interest, dividends, capital gains, those types of income items is going to have an additional 3.8%. So when we think about like long-term capital gains, the top tax rate is 20%. But if you're at a certain income level, it's actually 23.8%. So for people that have, for example, like if they sell their business, one of the things you have to consider is for that year where your income is going to be higher, what is the impact of this additional 3.8% you might have to pay that year?
Okay, great. So operating a business can be confusing with ever-changing tax laws. How much working capital should a business maintain, and how might this look different with the potential tax changes?
Yeah, so typically what lenders want to see is a working capital ratio of about 1.5.
Okay.
So for anybody that doesn't know, working capital is essentially your current assets divided by your current liabilities. It's trying to get at, do you have enough that you can convert into cash to pay what you're going to have to pay over the course of the next year?
Okay.
So that's what we mean by current assets, current liabilities. What can you convert to cash in the next year, and what do you have to pay in the next year, essentially? So banks typically like to see a ratio of 1.5. So you need to have 50% more capital than what you're going to need in the next year.
Okay.
With these tax implications, we could see those ratios really start to drop because companies are going to have to spend their cash paying their tax liabilities. So if you went from having very small tax liabilities or having losses in the past and you were right around that 1.5, and all of a sudden this year you've got a 7-figure tax liability, well, maybe now you're more like a 0.7.
Okay.
Which lenders are going to be very concerned about because you don't have enough cash to pay off your liabilities for the upcoming year.
Okay. So I know that there are some potential changes still under discussion. Can you walk us through those and the impacts that they would have if implemented?
Yeah, so there are a lot of proposals out there. There are proposals by the Democrats, there are proposals by the Republicans. I'll talk about the Democrats first. They had the Build Back Better Act that they've been trying to push under the Biden administration. And a lot of that was intended to reverse a lot of things that the Tax Cuts and Jobs Act did. So, for example, the corporate tax rate went down to 21% under the Tax Cuts and Jobs Act. Build Back Better would put it back to 26.5%, whereas it was 28% before. So kind of reversing a lot of the things that we've seen in order to raise additional capital for the federal government to pay for a lot of the programs that Democrats want to put in place.
Okay.
So kind of creating a lot of revenue raisers versus reducing taxes. So then on the Republican side, we've talked some in the webinar and a little bit here about how a lot of these tax benefits are being phased out starting even as early as 2022, most of them being gone at the end of 2025. A lot of what the Republicans have done is now that we're getting into these years with the phase outs and businesses are starting to realize the implications, they're starting to scream about the tax liabilities they have to pay. And there are a lot of lobbying groups putting pressure on Congress to fix a lot of these things that are being phased out and either make them permanent or at least extend them for a number of years, because a lot of people weren't expecting these changes, weren't expecting these high tax liabilities. And all of a sudden you go from I haven't paid tax for 5 years to I owe 7 figures, or I've been paying $100,000 a year and this year I owe $2 million, and that wasn't something you'd really planned for because there was some small change in the law. So there are what are called the big three that the Republicans are trying to get changed. There are multiple bills in Congress right now trying to get these changes through. They'll probably make it through the House. The Republicans control the House. Probably not going to make it through the Senate right now. So we'll have to wait and see what happens in the 24 elections. Okay. But the proposals, the big three that they're trying to fix is bonus depreciation we talked about. So that's phasing down. So it's eventually zero. They want to extend that 100%. Because we've had 100% now for roughly 15 years or so. Companies are very used to being able to deduct whatever they put in service in a year. So all of a sudden now being able to do that is a huge hit to companies that are fixed asset heavy, like a company that rents assets. Those would no longer be able to be deducted in a year if you buy them to rent them. So bonus depreciation is one of those. We talked a little bit about in the webinar the limitation on the interest expense deduction. So there's a rule that came into play with the Tax Cuts and Jobs Act that limits the amount of interest expense you can actually deduct in a year. But then starting in 2022, there was a change in how that limit was calculated. So starting in 2022, businesses that could fully deduct their interest in the past may no longer be able to do so. and under a lot of circumstances can't deduct any of their interest expense.
Okay.
So there's a big push to get that fixed and go back to the previous calculation of the limit. And then the third one that they're really pushing for now is there's a research and development tax credit that's in place. So as companies research new products, new services, things like that, there's a tax credit that they get to take for doing so because we want to inspire innovation in the United States. Mm-hmm. One of the things that the Tax Cuts and Jobs Act did was that starting in 2022, in the past, you could take those expenses and deduct them, plus get the tax credit. Starting in 2022, you get the tax credit, but you can't deduct the expenses, not all right away. You have to deduct them over a 5-year period.
Okay.
And so companies that spend millions of dollars on research and development were used to being able to deduct those expenses plus get a tax credit for those expenses. Now all of a sudden have large tax liability because they have credit, but they can no longer deduct millions of dollars worth of expenses. Now, eventually, when we get 5 years down the road, if they're spending roughly the same every year, we'll kind of get back to the same place because of that 5-year amortization period for the expenses. But what Congress with the Republicans are trying to do now is fix that so you can just go back because eventually you get back to the same place anyway. So what the Republicans are trying to do is just fix it so we don't have this 2 or 3 year period where companies that are R&D heavy are having large tax liabilities.
Okay. Thank you for that. It was very thorough. So are there potential tax breaks coming that businesses should be aware of?
So in terms of what's in the law now, really no, because a lot of the benefits are expiring. And part of the reason we're having this phase out of these benefits, or these provisions are what they call sunsetting, is there's a rule in the Senate that over a 10-year period, tax bills have to be revenue neutral. So what that means is it's kind of a zero-sum game. If you give one business or one industry a tax break, well, somebody else has to get hurt to the same degree to offset it and get back to zero over a 10-year period. So a lot of what the Tax Cuts and Jobs Act did was it front-loaded the benefits. Hey, we're going to benefit a lot of people in the first 4, 5, 6 years, but then after that, we're going to take a lot of that benefit away because we have to start paying for it. And so we've got a lot of these benefits are starting to phase out. No, there's nothing in the current law that's going to be a benefit going forward. The real benefit is if we get some of these, like what the Republicans are pushing, to fix some of these phase outs and not have them come into play.
Okay.
And then if they were to come back and do additional benefits down the road, it just, you got a lot of deficit hawks on the Republican side.
Okay.
So they don't mind fixing some things to keep it the same, but they're not necessarily willing to create new benefits going forward. That it was real tough with Trump getting the Tax Cuts and Jobs Act passed because of those deficit hawks, because they didn't want to increase the deficit by front loading all those benefits in the early years. So getting additional benefits going forward, I predict will be fairly difficult over the next couple of years.
Okay. How could these potential tax implications affect business valuations?
Yeah, so that's a great question because everybody involved in these acquisitions is going to be looking at what is the potential cash flow of that business after the acquisition. That's kind of how you set that purchase price, you know, and you typically look at past performance to predict future cash flow.
Sure.
But we know that going forward, there could be some potential tax implications that in the past, you would do it based on EBITDA, so you don't include taxes when you're calculating that value.
Okay.
But with these implications coming forward and knowing that the tax liability can be significantly higher, a lot of businesses, when they're looking to make a purchase, might start taking those tax implications into account and therefore lowering the purchase price they're willing to pay for a business because they know they're going to have to pay these tax liabilities.
So as we wrap up, how might business owners be proactive in business planning while being mindful of tax law?
Yeah, that's a great question. So we talked about this a little bit in the webinar, but I think, you know, there's so much change, and from one year to the next, tax law is so different. Your tax liability could be so different. They've added so many layers of complication because there are certain tax benefits that impact certain industries. There are certain tax implications that hurt certain industries because you got to get to that zero-sum game. So it depends a lot on what industry you're in. But I think what you have to do is look at your individual circumstances, and you have to project out, I would say, a minimum of 3 years, probably 4 or 5 years, based on current law. What are those tax implications going to be? What's the impact to your cash flow going to be? Because you don't want to get to year 2 and realize, hey, there's a $3 million difference in our taxes we didn't take into consideration. So just because your taxes were a certain way last year, I guarantee you they're probably not the same way this year. And from this year, they are not going to be the same way next year. So you really have to plan that out over multiple years and see what the impact to your cash flow is going to be.
Okay, thank you. So how can business owners protect the value of their business considering the tax law changes?
Yeah, so I would say definitely work with your tax advisor, do those projections, come up with those tax strategies specific to your industry. So in the industries that we work in, there are lobbyists for every industry, and they try to sneak little things in the tax code for their industry. And a lot of times they're pretty successful at doing so.
Okay.
So there are always little tax benefits within the tax code for certain industries and certain activities that industry performs.
Okay.
So trying to find somebody that knows the benefits for your industry and helping get those implemented for you. Because a lot of times when we talk to clients for industries that I work in, and we look at last year's tax return, I can typically identify between 10 and 15 things that they could have done differently that would have made a huge tax impact for them. So if you're working with somebody that's a generalist, I would also just, even if you want them to do your tax work, that's great. We need generalists. We need people that are just out there getting the tax compliance done. But you also need that industry specialist that can come in and say, look, do these 5 things and it'll save you this X much money. And work with somebody that knows those ins and outs of the tax code and how that impacts each year.
Right. And that is why you work with a tax specialist.
Exactly.
Okay. Yes. Well, thank you so much for being here. We love having you here on the show.
No, thank you. I love coming here. You can tell I have a little bit of a passion for dealing with these issues.
You come alive.
Yeah, I get very excited talking about this stuff. So I love coming here. So thank you for having me.
Thanks to you. So thank you very much for being here. Hopefully our listeners are able to share this with their organizations and be more mindful of 2024 tax changes. Thanks all for listening to On Point, a podcast by Oak Street Funding, where we bring research and data-backed insights to dig into the minds of industry leaders to learn how to stand out and navigate and break through this ever-changing industry. I'm Bridget Hyde, and tune in next time wherever you listen to podcasts as we get on point. And don't forget to subscribe and leave us a review.